A stock is a type of investment. It represents a small piece of ownership in a company. When you buy a stock, you're buying a tiny slice of that company. Think of it like buying a single brick in a large building. Stocks are also known as shares or equity. They are traded on stock exchanges, which are like marketplaces for buying and selling stocks. The price of a stock goes up and down based on how well the company is doing and how many people want to buy or sell it. Imagine your favorite clothing store. It's a place you love to visit, filled with the latest trends and styles. You might not think about it, but behind the scenes, there's a lot that goes into running that store. They need money to open new stores, expand their inventory, and maybe even improve their online presence. But where does that money come from? So they decide to sell small pieces of ownership to the public. This process is known as issuing stock. By doing this, they can raise the capital they need to grow and improve their business. These pieces are called stocks. Each stock represents a tiny fraction of the company. When you buy a stock, you're essentially buying a small piece of that company. When you buy a stock in the store, you become a part owner or shareholder. This means you have a stake in the company's success. The more stocks you own, the larger your share of the company. You own a tiny piece of that company's business. It's like owning a small slice of a big pie. The size of your slice depends on how many shares you own. As a shareholder, you have the potential to earn money in two ways. This is what makes investing in stocks so appealing to many people. First, the value of your stock can go up over time. If the company does well, its stock price will likely increase. This means your investment becomes more valuable. If the company does well, more people will want to buy its stock, driving up the price. This is known as capital appreciation. It's one of the main reasons people invest in stocks. Second, some companies pay dividends to their shareholders. Dividends are regular payments made to shareholders out of the company's profits. Dividends are a portion of the company's profits that are distributed to shareholders. This can provide a steady income stream, especially if you own a significant number of shares. Investing in stocks can be a great way to build wealth over time. However, it's important to do your research and understand the risks involved. Not all stocks perform well, and the stock market can be unpredictable. By staying informed and making smart investment choices, you can increase your chances of success. Remember, owning a piece of the pie means you're part of the company's journey, sharing in its ups and downs. So next time you visit your favorite store, think about the possibility of owning a piece of it. It could be a rewarding experience both financially and personally. Equity is another word for ownership. When you buy stock, you're buying equity in a company. The more stock you own, the larger your ownership stake in the company. For example, if a company has issued 100 shares of stock and you own 10 shares, you own 10% of the company. Equity is important because it represents your potential claim on the company's assets and earnings. If the company is sold or liquidated, equity holders are entitled to a share of the proceeds. Let's say you buy stock in your favorite coffee shop. The coffee shop uses the money from selling stock to open new locations and improve their menu. As a shareholder, you're hoping that these actions will make the company more profitable. If the coffee shop's profits increase, the value of your stock is likely to go up. This means you could sell your stock for more money than you paid for it. Additionally, the coffee shop might decide to share some of its profits with shareholders by paying dividends. Section 5. Common stocks versus preferred stocks. There are two main types of stocks: common stocks and preferred stocks. Understanding the differences between these two can help you make more informed investment decisions. Common stocks are the most common type of stock. They represent ownership in a company and a claim on part of the company's profits. They give shareholders voting rights in the company, allowing them to have a say in corporate decisions, such as electing the board of directors. However, they don't guarantee a fixed dividend, meaning the dividend payments can vary based on the company's performance. Preferred stocks, on the other hand, typically don't come with voting rights. This means preferred shareholders usually don't have a say in the company's major decisions, but they do offer the potential for regular dividend payments, which are often fixed and can provide a steady income stream. Think of common stock as being a regular member of a club, with voting rights but no guaranteed perks. You get to participate in the decision-making process, but your benefits depend on the club's overall success. Preferred stock is like having a VIP membership, with potential perks like regular dividends but no voting rights. You might not have a say in how the club is run, but you enjoy consistent benefits regardless of the club's performance. When it comes to risk and reward, common stocks are generally considered riskier than preferred stocks. This is because their value can fluctuate more dramatically based on the company's performance and market conditions. However, they also offer the potential for higher returns. Preferred stocks, with their fixed dividends, tend to be more stable and less volatile. They are often seen as a safer investment, especially for those looking for steady income rather than significant capital gains. Deciding between common and preferred stocks depends on your investment goals and risk tolerance. If you are looking for growth and are willing to take on more risk, common stocks might be the better choice. If you prefer stability and regular income, preferred stocks could be more suitable. Ultimately, a balanced portfolio might include both types of stocks, allowing you to benefit from the growth potential of common stocks and the stability of preferred stocks. By understanding the unique characteristics of each, you can tailor your investment strategy to better meet your financial goals. Remember, investing in stocks always carries some level of risk, so it's important to do your research and consider seeking advice from financial professionals. Whether you choose common stocks, preferred stocks, or a mix of both, being informed is key to making sound investment decisions. Section 6. Entering the stock market. To buy and sell stocks, you need to open an account with a brokerage firm. A brokerage firm is like a middleman between you and the stock market. They handle the buying and selling of stocks on your behalf. Once you have a brokerage account, you can start buying and selling stocks online or through a broker. It's important to do your research before investing in any stock. Look into the company's financials, management team, and industry trends. Section 7. The Stock Market Playground. Welcome to the dynamic and ever-changing world of the stock market. The stock market is like a giant auction where buyers and sellers come together to trade stocks. Imagine a bustling marketplace where everyone is trying to get the best deal. The prices of stocks fluctuate throughout the day based on supply and demand. Just like in any market, when more people want to buy a stock, its price goes up. When there are more buyers than sellers, the price of a stock goes up. This can happen for various reasons, such as positive news about the company or overall market optimism. Conversely, when there are more sellers than buyers, the price goes down. This might be due to negative news, poor earnings reports, or broader economic concerns. The stock market can be volatile, meaning that prices can change quickly and unpredictably. This volatility can be driven by a multitude of factors, including economic data, geopolitical events, and changes in investor sentiment. It's important to remember that investing in the stock market involves risk. While the potential for high returns exists, so does the possibility of significant losses. You could lose money if you invest in a company that doesn't perform well. Therefore, it's crucial to do thorough research and consider your risk tolerance before making any investment decisions. History has shown us that the stock market can experience dramatic downturns, such as the Great Depression in 1929 or the financial crisis in 2008. These events serve as reminders of the inherent risks involved. However, the stock market also has the potential for great rewards. Many investors have built significant wealth by investing wisely and staying patient through market fluctuations. Staying informed about market trends and economic indicators can help you make better investment decisions. Watching financial news and reading market analysis can provide valuable insights. Diversifying your investments is another key strategy to manage risk. By spreading your investments across different sectors and asset classes, you can reduce the impact of a poor-performing stock on your overall portfolio. Remember, investing in the stock market is often a long-term endeavor. Patience and discipline are essential. Over time, the market has generally trended upwards, rewarding those who stay the course. Educating yourself about the stock market and investment strategies can empower you to make informed decisions. There are many resources available, from books and online courses to financial advisors. In conclusion, the stock market is a complex but potentially rewarding playground. By understanding its dynamics and being mindful of the risks, you can navigate it more effectively and work towards achieving your financial goals. Section 8. The risks and rewards of stock investing. Investing in stocks can be a great way to grow your wealth over the long term, but it's important to understand the risks involved. The value of stocks can go down as well as up, and there's no guarantee that you'll make money. However, Over the long term, the stock market has historically trended upwards. This means that if you're patient and invest for the long haul, you have the potential to earn significant returns. Section 9. Diversification. Don't put all your eggs in one basket. One of the most important rules of investing is diversification. Diversification means spreading your money across different types of investments, such as stocks, bonds, and real estate. This helps to reduce your overall risk. If you put all your money into one stock and that stock goes down, you could lose a lot of money. However, if you diversify your portfolio, you're less likely to be wiped out by a single bad investment. Section 10. Learning the ropes. Your journey to stock market success. Investing in the stock market can seem intimidating at first, but it's easier than you might think to get started. There are plenty of resources available to help you learn the basics. You can read books, take online courses, or even consult with a financial advisor. The most important thing is to start small and gradually increase your investments as you gain more knowledge and experience. Remember, investing is a marathon, not a sprint. As Section 11. Start small, dream big. Investing in the stock market can be a rewarding experience, both financially and personally. It allows you to become a part owner in some of the world's most innovative and successful companies. While there are risks involved, by starting small, diversifying your investments, and continuing to learn, you can set yourself up for long-term financial success. Remember, the stock market is a powerful tool for building wealth, and with the right knowledge and approach, you can achieve your financial goals. So start small, dream big, and enjoy the journey.